Just last Friday, we should remind you, our chart master was eyeing Google for a breakout to new highs. Well, he's back. Carter's back. He's over at the Plasma to tell us what to expect from Alphabet now. Carter.
Well, it looks like that breakout is going to be deferred by a day or two, which is to say we're not getting it, but I think we will. The key number here, at least by my work, would be the following: 1, 2, 6, 4, 30. That's where the stock closed on Friday. So if one went into the weekend and owned the stock and one has done nothing today and is living through this right now, we can, of course, see that after plunging as low as 1230, the stock is trading at 1275, meaning if and as it opens here tomorrow, one is up from where one was just on Friday last week. So in terms of the breakout, it's just going to be deferred. It's not going to break out tomorrow, but the key is that these levels are deadly precise, and often you have to contend with a prior high before exceeding it, and ultimately, of course, I think Google will exceed it. Apple has broken out. Big stocks like a JP Morgan or a Nike, ultimately this one will as well. In terms of how precise this is, and this speaks to the importance not of the charts that I'm showing you, but charts in general. Is it random that this high in July was 12.91 and this is 12.96? This is 12.96? Of course not. People look at 52-week highs, algorithms hunt them down, and then there is momentum. If and as you break out in a big way. One of the things about a breakout is there's no one who's unhappy once it's making new all-time highs, unless you're short, which represents prospective more buying as people have to cover. So the setup is this, the setup is this, the setup is this. It all suggests that while it is going to be deferred tomorrow, it is what's going to happen for Google. In terms of the market overall, just because it is a big day, this day here was the highest weekly RSI reading ever recorded in the history of the S&P. That includes 1929, 1987, and the dot-com peak in 2000. And if you draw the internal trend line since that day, every time we have come up against this line, we have backed away. And since that peak, stocks have underperformed cash, underperformed bonds, and underperformed gold. We are right up against that level again, and earnings are out of the way. I don't quite see what the catalyst is to get us above that line. I think once again we'll struggle right there.
You know, Carter should come on over.
I think he's
got
got a lot to talk about.
Will's going to bring the chair in.
A lot to talk about.
Yeah, lots of questions for Carter.
Thank you, Will.
Okay, Will. What's going on?
Welcome.
Will your view of the S&P
treats? There's nothing to eat.
No, I told
Sorry,
you.
we don't. By the way, we're on a health food diet.
We have a nut and fruit bag now.
Some super fruits for you.
So in terms of your view on the S&P 500, will any of that change based on this deferred breakout of Google or Apple's earnings later on this week, or any of the other big earnings?
What's interesting is if you think about, there's latent potential and then there's exploitation of potential, right? A stock sitting at a breakout juncture represents potential. If and as it breaks out, you've exploited some of that potential. So JP Morgan represented potential. It has broken out. Nike, it is broken out. Apple, it is broken out. And others have not, Netflix, Amazon. But once they're out of the way in terms of earnings, what is the potential here to press us to big new highs? It would have to be a further spike in cyclicals, which a lot of people are making that bet, but I think they've come a long way. Or it would have to be other breakout candidates carrying the load. And as you go through the earnings period, there are fewer and fewer stocks in a position to break out because we've heard from so many of them. So I think you get to that line and you back away from that line just as we've done repeatedly.
So, Carter, I could draw the similarities to the S&P over the same thing, sort of a tag on along to what Melissa just said on Google stock. So every time we got to a certain level, backed off. Every time we get that certain level in the S&P, backed off. The charts are similar, not the same. Why one is more likely to break out versus the other?
One is making incremental new highs. That's an ascending or internal trend line in the S&P. The Google is flat tops at a common level. So Google's made no progress, where the S&P is making slight new highs, which kind of draws capital in, makes it think it's okay. But again, if a risk asset is underperforming gold, cash, and bonds for 2 years, the bull would say that's the opportunity. It's taken so long and nothing's happened. The bear would say this is what a topping process is like.
So to talk about the S&P, so you know, here we are, that October 1st, 2018 high. We're about 3.5% above that now, and it's the end of October 2019. So you just mentioned incremental highs. All of those highs that we've had over the last year have been above that 2018 high. Does that set up very bullish to you? I mean, the longer that we've had this
what you need is if you take the exact same day and you look at the New York Stock Exchange composite, the mid-cap composite, the Russell 2000, the transports, the banks, none has exceeded that high. So you have that bifurcation or divergence with so much money in a few big names. And for the most part, they've done well. Apple's done well, Google's done well. But now Amazon's a little bit of a struggle, Netflix a little bit of a struggle. So it's case by case. But what we do know is that if you take the broadest aggregate of all, we can end it with this, right? That the MSCI All Country World Index, $70 trillion, twice the S&P, is still well below it where it was in that fateful Friday, January 26, 2018, almost 2 years ago.